thank you to the Stock Exchange for inviting us to participate in this event, and thanks to everyone who's joined. I will take you through our presentation where I'll walk you through our recently announced results for the financial year and interims, but keeping in mind the theme of this event, which is gearing up for the challenges, and talk you through how we are coping with some of the existing challenges and dealing with it in terms of how we did over the last year and most recent quarter, as well as our sort of outlook and how we are managing things. So just looking at the recurring EBITDA performance for the quarter, I won't go through the specifics in the interest of time, but we had a strong quarter. We saw our recurring EBITDA grow around 150% for the quarter, driven by sort of growth in a lot of our businesses, particularly our property business with recognition of revenue on our apartments at Cinnamon Life, as well as a strong performance from our leisure business where there was a significant turnaround, and then positive contribution from all our other verticals. I will talk you through some of the specifics as we go through each of the industry slides, but I'll move on now to the next slide. Looking at the performance for the year, it's a sort of similar story where the 150% growth, was for the year, but essentially, again, the annual performance was driven by the performance of the property business, significant turnaround in our leisure business, where we saw around the 7 billion rupee turnaround in the EBITDA performance, driven by the Maldives as well as Sri Lanka. So in terms of managing a tough year, I think there are a couple of key messages that I'd like to leave with you. One is the fact that we've been investing a lot in the Cinnamon Life project. It's almost $1 billion project with a long gestation period, so it's been in construction over the last sort of 7-8 years. But now I think the good thing from the group's point of view is after that long gestation period, we've actually come to the point where we are recognizing revenue and profits and seeing the cash flows coming in. This is from the sale and recognition of the apartments, but then heading into next year, we will have the recurring streams of cash flows from the hotel and conferencing operations also commence. So that's been, one of the big ticket investments for the group, and seeing that now come to light is something very positive from the group's perspective. Of course, we are facing some challenging times in the country, and I'll talk to you a little bit about what we're doing there. The Maldivian performance post-pandemic has been very positive, and that's supported the leisure business significantly as well. But if you look right across the board, you can see from transportation to retail, financial services, all the business verticals have performed quite well in the last year. Moving on to the next slide. This just sort of showcases the recovery momentum. And if you look at it, I won't spend too much time on this slide, but if you look at Q1 through Q4, you can see how the recurring EBITDA has grown quarter on quarter. And the main reason for this is, if we recall Q1 and Q2, we had pandemic-related disruptions in the country with lockdowns or isolation curfews, and that really dampened the performance of the group. And as we've come out of that, and particularly with the high vaccination rates in the country, you can see when business activity and movement of people becomes more normalized, how the consumer-related businesses in particular. So if you look at consumer foods, you can see the impact of Q1 and 2, and then as we move to Q3 and 4, which are more normalized, how the performance has changed. It's a similar story if you look at retail, maybe not as stark, and even leisure. So the takeaway from this slide is just to showcase the impact of the pandemic that it had even last year on the business. But as we've moved out with the high vaccination rates and people learning to live with COVID and sort of get on with life, you've seen how performance has been more normalized in Q3, Q4. So as we look forward, I think it's not to say that the pandemic is over or behind us in that sense, but I think with the booster doses, fourth vaccines being there and so on, we would hope that things would pan out more like Q3, Q4, where those type of disruptions would not be there, and that's been a significant dampener on our performance, as you can see on this slide. Now, of course, there are other challenges that the country has to contend with, and naturally our businesses as well. And we'll talk you through a little bit through that. Just moving on to the next slide, I think the annual performance last year, we did have some significant one-offs. I'm not going to spend too much time on this slide. We've detailed this out in our annual report as well. But for those of you just interested, we had some one-off impairments on our investment in the port, the goodwill. That's just from our original investment. We have some goodwill arising from the original investment, given that we have 7 years to run on the concession. And on Cinnamon Life, on the office complex, we opted to, as a matter of prudence, take some impairment on this. So there's about 10 billion rupees of one-offs that's there. So if you look at our reported EBITDA at 29 billion, our recurring EBITDA is at 39 billion because we've had these one-offs. Similarly, if you look at the table on the right, you'll see we had some exchange gains coming in, fairly significant exchange gains. But these exchange gains emanate from the fact that we've held on to some of our dollar cash that's earmarked for our future investments into Cinnamon Life, as well as some of our other obligations. So whilst we have benefited from the exchange gains, I would like to reiterate the point that these are actually funds held for these obligations. So if you look at the net impact, we've had about 12 to 13 billion rupees of exchange gains. So if you look at our reported PBT at 27 billion, you need to adjust that out because that's within the PBT figure, though it's not in EBITDA. But on the other side, I spoke of the 10 billion already. So you need to add that back. So on a recurring basis, our PBT, even eliminating for that exchange gain, is still at 24 billion rupees. Moving on to the next slide. I think this is an important slide just in terms of, how we've geared ourselves to, handle challenging times. Though we may not have envisaged challenging times like we are seeing right now, we did sort of plan for strengthening our balance sheet through the pandemic, ensuring that we had enough cash and reserves to complete our large projects, undertake new projects like the West Container Terminal investment. So with that, we've sort of ensured that all these investments can be taken care of. We've also, over the last few years, as we've been telling our investors, ensured that we've sort of continued investing in building capacity and expanding our businesses. And that's really coming to fruition, and we're seeing the benefits of that coming through. And I'll talk to you a little bit later as we conclude this presentation. I'll get into that detail. But here the takeaway is, if you look at our debt figure on the face of our balance sheet, is our total debt has increased significantly from last year, from around 147 or 150 billion to around 230 billion. But there's an impact here in that we are carrying foreign currency debt relating to our Cinnamon Life project, as well as at the holdco, where we raised funds to the tune of $175 million from the IFC. Now, these funds, naturally, because they are in dollar terms, with the significant depreciation of the rupee equivalent of our debt has increased significantly. But if you look at the second line on the table, you'll see the cash and cash equivalents. And this goes back to the point I just made earlier about the cash that we've been holding. And there again, we've benefited from the translation of the cash, because that cash is also held in dollar terms. So there's a significant increase in our cash rupee equivalent of our cash held. So I think what's most important here is the third line. If you look at our net debt in rupee terms, yes, it has increased as we continue to sort of fund and finish some of our projects, but our net debt is at 77 billion rupees. And if you look at that number against our recurring EBITDA of 39 billion, we are looking at a net debt to recurring EBITDA of around 2 times, which is a very healthy number. So I think, we've ensured that our balance sheet can and will take care of, funding our future investments that will continue to keep the growth momentum, that helps us navigate these sort of troubled times, and also ensure that we've got enough of sort of dollar cash available to meet our dollar liabilities. So I think that's one of the key things we've done over the last few years with the pandemic, as well as expecting some macro stressors. Like I said, maybe certainly not to the extent that we are seeing today in the country, but I think the balance sheet and everything we've done will really help us navigate through these times. Moving on, I won't go through each of these slides in the interest of time, but I think a key couple of takeaways, if you look at our ports business, I spoke of some of the investments we're doing with the West Container Terminal. Those are dollar revenue streams that we would get. It's a 35-year concession, so it gives us a long-term exposure to a very strategic investment, given the strategic nature of the Port of Colombo, which I think all of you all know. What's interesting with the slide on the right is how the volumes in the Port of Colombo have grown from 2013 to 2018. And that's really because of the capacity enhancements with the deep water facility coming through in the Port of Colombo. And after that, the volumes have seemed to stagnate, but that really is as a result of us as a port, overall port, really reaching capacity in a sense. I mean, there is some spare capacity, but there's not a whole lot to maneuver. So the need for expanded capacity is really telling. And also what you can see is when you have new capacity coming in, how quickly that gets absorbed, which is what you can see on the chart on the right, how from 2013, every year it's grown quite significantly. Moving on to, I'll skip the next slide in the interest of time and move on to the following one. If you look at our consumer foods business, we've seen strong growth through double-digit growth in volumes in our ice cream, soft drinks business, even our convenience foods business. Now, we are seeing some challenges naturally with the depreciation of the rupee, the global supply chain impacts that are coming through. So if you look at our recurring EBITDA margin at 17%, it's down from 20% in the previous year. But if I go to the next slide and just break that down quickly for you, you see the impact of that through the different quarters. Just moving to the next slide, please. You'll see how the recurring EBITDA has moved from Q1 at 9% to 13%, and then recovered to around 18 to 20% in Q3 and 4. That again is really the pandemic related impact. So if you look at the second half, we are really at about 20% average margins for the year. Now, having said that, going forward, there are a lot of challenges with the cost increases that we're seeing, significant inflation in the country, and we are taking price increases where possible as well, whilst looking at all aspects of production efficiencies, looking at the profitability mix of our portfolio to ensure that we sort of navigate over the next couple of months. I think the biggest challenge in the next couple of months is just ensuring that the supply chain disruptions are minimized as much as possible. In our retail business, which is covered in the next slide, we've seen strong growth driven by footfall as well as margin improvement, and inflation, of course, helps a retailer. So that business has seen strong growth. We've doubled our sort of outlet footprint over the last couple of years, and that has really helped. I will move on to the next couple of slides. I'll just skip through and maybe go to the leisure slide. Thank you. So here, if you look at it, Maldives, we've seen a significant recovery. In Sri Lanka, we saw a recovery till April, and then things slowed down naturally with the disruptions we've seen with some of the essentials, and then of course with the violence that we saw. But I think the key takeaway here is that we expect to see a recovery in Sri Lanka once the ground situation settles. We know how quickly things can turn around. You can see, in the Maldives, there's clear pent-up demand, and that's something that sort of really augurs well for leisure travel globally as well, though there are some challenges with oil prices and the Russia-Ukraine conflict, but we haven't seen a slowdown really yet, and that trend is likely to continue. So Sri Lanka, we can really benefit significantly. And we just move to the next slide. You can see, with us being in proximity to India, just a couple of hours flight time away from a lot of key Indian cities, the type of impact that India can have on Sri Lankan tourism. So what you see here on the left, the bars, is what happened in China over the last 20 years and how Chinese outbound travel has grown exponentially. Now, India also has grown off a lower base from 4 million to 27 million, but with growing prosperity in India and expectations for their middle class to become that much more affluent, you could see India following a similar trend as we've seen with China over the last 10, 20 years. And if that happens, we really just need for Sri Lanka only a fraction of this. And for us to move from 2 million tourists to 4 or 5, with India leading the way, is a very, very real possibility. And that's what we would be banking on. If we just move on to our property business, skip some of these slides, which are more earnings updates. We've seen strong sales with our Cinnamon Life project as we've completed the apartments, and we now get into completion of the rest of the project. I'll get into the details maybe later on in the interest of time. I'll just move on. We see some images on Cinnamon Life, and I think just before this significant depreciation, we started seeing a lot of interest in the apartments, given that it's an iconic development and it's really now taking shape. If we just move on to the last slide, I will just, the one before the last slide, please. I'll just wrap up with this slide. Keep going, please. Next one. Just two more. Yeah, this one. Thank you. So if you look at this slide, I think what I'd like to sort of talk you through is how our recurring EBITDA has performed over the last 4 years. Each of these years have had some disruption or some impact. If you look at 1920, there was the impact of the Easter Sunday attacks and then the pandemic, but we bounced back strongly. I think the key thing here is if you look at a lot of the businesses from 1819, we've seen strong growth. Some have grown steadily, but most have grown quite strongly. And this is a result of a lot of the investments we've done. And a lot of the narrative that we've been talking about has been the fact that we've been growing our capacity, building capability in a lot of our businesses, and that's now starting to take shape. Now, whilst we know there are challenges in terms of the currency, shortages of materials, supply chain issues, interest rates, and so on, and tax increases, which will affect some of our businesses, we are very confident of the sort of medium to long-term prospects. And you can see how our businesses have really come out, even with pandemic-related disruptions, the type of turnaround we've seen. If you look at our leisure business, you can see a 3.7 billion profit, but in 1819, we did a 5.4 billion profit, even without having a full complement of rooms available. So the potential is far, far greater. Our retail business, we are now just starting to get the benefit of scale. We've invested in a new distribution center, so that brings in a lot of efficiencies. So a lot of these things are now translating to better growth prospects. Now, it doesn't mean that we won't have challenges in the immediate term. Our immediate focus is on ensuring our supply chains can continue, how we look to diversify our sort of supplier bases so that we ensure less disruption to our supplies, particularly on the manufacturing side. The tax increases that have just been announced and which were anyway expected could have some dampening effect. But right now we are seeing strong volume growth. I think there are some offsetting impacts as well. If you look at our retail business, inflation helps the top line of a business like this. We're seeing conversion from the general trade to modern trade. So there are offsetting impacts. The transportation business is a dollarized business. Our ports and bunkering business have been doing very well, and expectations are that that will continue given everything Sri Lanka has been able to achieve on this front. The leisure business, like I said, Maldives will continue. Sri Lanka will hopefully bounce back in the next quarter if the social situation settles. Property can see some challenges because of the significant increase in the price of real estate. But again, one thing to keep in mind is that there won't be any new developments coming up with the current uncertainty that's there. So the supply that you see in the market, the current inventory that's available in the market, will be all that sort of available. And the cost of constructing new developments or the replacement cost of these will be significantly higher. So once the market settles down, we are confident that there will be demand, because for the moment, it will be a finite inventory that's actually available. So let me just stop with that. I just wanted to give you a sense of how we are dealing with the current situation and what are expectations for some of our businesses, notwithstanding, of course, some of the short-term challenges. And thank you very much.